Hey everyone, it is Evan here from the Trade Risk on Tuesday, December 18th, here with a midweek market recap video. We're going to cover all of the major markets and the current market environment. So getting a little bit of a head start on today's video, recording this about 5 or so minutes before the bell. So some of these prices are going to change a little bit. They won't be exact final values, but you can see here looking at our market technicals dashboard, you can see we are bouncing slightly here today in mildly green territory across the board. That comes after a very difficult start to the week. Yesterday, sellers were certainly in control, breaking us down through some support. So we'll talk about that when we look at the charts. But the 5-day change still in the red here. We're below all of the key moving averages. We're below last week's lows, and we basically have a sea of red here when we look at the individual sectors. Basically everything in red territory except for semis, just trying to close or hang on to flat here over the past 5 days. And we can see the VIX has spiked now over 18, almost 17% over the past 5 or so days. We got commodities down here. The dollar's been strong, and commodities have been weak as of recently. So let's jump now into the charts here with the Sp500 weekly time frame. This is where we like to start our analysis, get the big picture view, and you can see we are getting, in fact, that follow through selling to last week's breakdown candle. So remember last week we were just flirting with the bottom end of this range, and we talked about the dicey action here, the fact that we could see either a sharp move lower or we could get that quick pop back up to the upside. And it was an inflection point that the market was kind of sitting at, and it was a tough spot to pick with great degree of confidence which way the market would sort of tip its hand. And we certainly got the way the market tipped its hand yesterday. And the good thing about yesterday was it didn't come in the form of the selling yesterday. When we look at a daily chart, it didn't come in the form of a big overnight drop. You had a chance in the regular trading hour session to actually tighten up exposure, because we did open more or less flat yesterday, down slightly, rallied a bit, but you had opportunity to sort of get out if you were using this 2600 level as sort of a line in the sand, or follow through as a line in the sand. But here we are now. We do have a slight bounce here on Tuesday, but we're still down 2% on the S&P 500, and we are tagging slightly undercut the year-to-date lows back here in February. So we're at, if we zoom out here, if we just kind of frame out this big price action here, which is what we've been looking at, this range from 25.33 to 28.72, we are now at the bottom end of this range, retesting the year-to-date lows. Now, the important thing here is that there is certainly a big air pocket below here. This is kind of looking over the ledge here of a market that has broken a long-term multi-year trend line. We're now back to the year-to-date lows here, and when we think about what's support underneath this level, you could throw some fibs on there if you're a fan of fibs, and you could draw your latest swing lows to the recent highs up here and try and get some projected support that way. Or if you're just looking at price structure, which is what I prefer to do, really the next big swing low to really reference is down here around 24.21. So that's another 120 points below in the S&P 500. Doesn't mean we have to go there, but if we start to think about us breaking down and clearing to new year-to-date lows like the Russell's doing, we do have quite a big air pocket down here to contend with, or to really think about as our potential risk. The other important point is that, yes, we are now back at an important year-to-date low, an important price level at the bottom end of a range. If this is truly going to be a range that the market is going to start trading in for the foreseeable future, then this is the retest here that you'd want to see hold, and you would expect a violent bounce off of this area. Maybe we slightly undercut it, maybe we tag 2500, but that is where you would certainly want to see, from a bigger picture perspective, buyers show up to support us at the lower end of this range to prove that, yes, this is in fact going to be support. So it's tough to play the guessing game of which way this is going to go. We just like to map out the levels and think about the important inflection points so we can measure risk against. Right now here with the Fed tomorrow, which I think is actually an important, every Fed meeting is important, right? It's always the most important one ahead of us. But with 8 days left in the year, it's basically this event that is going to dictate the price action for the remainder of 2018. And we've certainly sold off. Maybe this is getting all of the selling in before the Fed, and that's kind of sell the news by you know, by the actual fact here once we actually get whatever happens, you know, rate hike or not. But there's been a lot of selling pressure into the event. It'll be interesting to see what happens tomorrow. The VIX is sitting at a very interesting spot right now. It's trading closing potentially at the highest level we've seen since February of this year. So if it can close up here at 25.61, you can see that's going to be all the way up to basically April levels, and even higher than that would go all the way back to February. So the VIX here at the very top end of its range, you'd expect either, you know, a collapse tomorrow if the market likes the Fed reaction there, or this is going to accelerate and we're going to see some real capitulation tomorrow north of 25 in the VIX here, which would open us up certainly in the major indices to the downside, of course. So it'll be interesting. I think it's a risk event, so we have to be careful. This has already been a dangerous market, but if you're, you know, levered going into tomorrow, or you're taking a bold bet one way or the other, I think that's, you know, quite a risky endeavor, because I do think a lot of eyes are on there, just given the fact of where we are in the timetable, year-to-date closes, and everybody sort of wrapping up the books for 2018. So that is the broad landscape there for the S&P 500. Let's look here at the daily chart now, and we'll look at the S&P. We'll look at the SPY ETF. You can see with this action here, we did in fact actually close red. We just got the market closed now, and we did close red on the session here. You can see we did just briefly undercut yesterday's lows by a couple of pennies. It kind of bounced mildly here, and then again we're closing slightly into the red. So a very lackluster kind of poor close or poor performance here. We are stretched certainly to the downside, but I don't know if that means a whole lot just yet, given the fact that the trend is lower. To say you're oversold in a downtrend isn't exactly you know, any helpful sort of commentary here. I think tomorrow is going to be the price action of how it unfolds, some high volume reversal, some major capitulation, some gap and go. That is what we're going to be looking for at this 253 area at the year-to-date lows. The IWM, when we look here, of course, now this has just taken out the year-to-date lows, and as we, you know, sort of analyzed in our last video, this is now down approximately 10%, I believe, on the year, 10.24%, and we're in fact now at this point have given back almost all of 2017 gains. So we were up 13% last year. We're down 10.24% right now. So we've effectively retraced all of last year's trading. So if we look at the IWM versus the Qs, it was kind of the scenario that we proposed in the last video. What's going to win out here? The recent relative strength and the holding of support here in the Qs. Is that going to, you know, help firm us up and support this market, or are we going to in fact roll over like the IWM? So far, the IWM seems to be winning, but when we look here at the Qs, still hasn't quite given it up yet. It has been, and even today it was up 63 basis points. It was an inside session today for the Qs. So again, 156 here. We're just at some major inflection points, some important levels, and with the Fed tomorrow again, I think it's just going to be you know, the stage set for some fireworks. So that's really, you know, kind of just went through quick on all of the major averages, bottom end of the range, testing some year-to-date support and some big levels here. We are oversold. There's going to be volatility. We know there's volatility with the VIX trading at you know, highs seen over the past 8 or so months. So for your shorter-term traders, this is paradise. If you're a shorter-term kind of swing trader, overnight holder, you really need to protect yourself, in my opinion, into this type of environment. So that is I think everything that I wanted to talk about there for the major averages. Let's go to TLT next, which continues to act as a safe haven right now. Long bond here continues in its uptrend. It reclaimed that 117 level last week or 2 weeks ago, week and a half ago. It continues to hold it and trend above it. Good volume has come in here onto the upside, so there definitely seems to be a rotation now back into bonds here with rates falling, at least on the long end of the curve. If we go to GLD, this is also continues to act well. So your two kind of flight to safeties, gold, bonds, treasuries, these things are acting well right now as equity markets are sort of in some turbulent times. GLD closing back at recent highs here. If we go to the weekly chart, again, certainly not out of the woods. The structure over this year has been really difficult for GLD, but gold for now is at least working itself higher, up almost 1%. Bulls continue to hold this up in this trend. Go to silver next. You can see this is still just kind of moving sideways here. Channel, it's been been in $13.10 to $14. Probably going to go out the year inside of that range. And commodities, which USO took another leg down this this week. If we look here on the weekly chart, it's already down 10%. So if we look here on Monday's trading, it broke to new lows. So remember, it consolidated sideways for a couple of weeks, waiting to see what that continue, if that turned into a continuation pattern or some type of reversal pattern. It is clearly now, hindsight, looking at a continuation pattern to the downside. We broke down yesterday on Monday. We got accelerated kind of selling and confirmation here today. It's brutally stretched to the downside. If you throw on any standard deviation move, or you look at distances from moving averages, you can see we're at pretty historic levels at how much of a straight line that this has fallen for USO. Whether or not that means you want to jump in and try and catch the knife, that is certainly your call and your strategy. I think you always have to protect risk when you have a market in free fall, but there's certainly opportunity when you have this type of capitulation type of action, when you really have just real kind of pukey action here after an already straight down move. So interesting times there for USO is how that develops. And natural gas continues now at least to get the benefit, as we almost saw back on this first leg higher, as natural gas was ripping to the upside, oil was dumping. Now you can see oil dumping again, natural gas getting this bid. Now, to be fair, natural gas certainly traded lower by about 10%, actually, 20% from this pattern here. So this breakdown just about 4 or 5 days ago, this fell off 17%. It's incredible at how much ranges have increased here for natural gas, but now we saw a nice 7% pop back up. So real tough. When we look here at a weekly chart, you can see kind of got a hammer here on the week. Ugly last week, we were down 15-16% on the week. Now kind of recovering. Notice though, there really hasn't been, I know volume is sort of already kind of elevated here over recent month, but volume over this recent sell-off and even today's rebound here hasn't been extraordinarily high. It's still trading underneath this 20-day moving average, at least for the UNG ETF. So interesting to note, but a little bit of a bounce coming off here after a 20% move to the downside in natural gas. So that I think covers everything that I really wanted to cover. Remember, 8 trading days left, so almost time to call it quits for 2018. We got the Fed tomorrow. I think all eyes are going to be on that. Certainly going to be a catalyst. VIX, interesting spot right now. This thing is either going to, really flare tomorrow, where you're going to see a nice solid move up stretching to 30 plus VIX, or we're going to get the collapse here and the rotation back into equity markets. Be interesting to see how this all plays out. Protect yourself. Remember, don't have to be a hero. Don't try and make your year on this last week. It's very dangerous mentality to fall into. It's better to just sort of wind down and start fresh next year. So that is what I have. Thanks so much, as always, for tuning in and watching the market recaps every Tuesday and Friday. You can subscribe on YouTube or follow us on the Trade Risk every Tuesday and Friday. Thanks so much, and we'll be back later this week.